Hello, fellow rebel capitalists. Hope you're well. I am super excited to be here with my good friend, Lynn Alden. Lynn, thanks for coming on.
Happy to
There's
be
not
here.
much to talk about, is there?
Never is, I guess.
So the biggest thing in the news, I want to talk about that first. And that is you calling Elon Musk a cuck. So can you explain that to us really quick?
Well, so I think it's a problem of false marketing, right? So I think that Elon in the SpaceX thing, I think is interesting. I'm not really that critical of SpaceX. I think when you get out to the other stuff, it's really about marketing and it's really about hype and it's really about selling equity. The one thing he's really good at is selling people on an idea, selling equity. And the problem is that the things he uses to sell equity are not
Right.
usually very true, which is, when anyone's good at marketing, it's that fine line. You want to like present a positive vision, but you want to be accurate because you want to build that reputation over time. And I think that's what something like, say Steve Jobs nailed really well. He painted a very optimistic thing, but he generally backed it up. Whereas, for example, with Tesla, it's always like, full self-driving and, we're not even going to need steering wheels and a million robo-taxis and things like that. And then the timeline comes and go, and it's not even remotely close. It's not even like you're off by a little bit. It's like you're not even in the realm of, and people actually buy those cars or buy that equity based on that assumption. And we kind of saw it recently with the whole foray into Twitter. He kind of positioned himself as anti-censorship, kind of positioning himself with things that are good, but then he goes around and just does the same thing. It's like, here's the new king, same as the old king,
Right,
type of
right.
thing. And I got provoked because Substack was blocked. I don't even use Substack, but then I saw
With Doomberg, yeah,
Doomberg was like retweeting it. I couldn't even like Doomberg's tweet. And I'm like, this is really what we're doing here? This is like clownish.
right.
And
So
I think
that's
that,
what,
yeah, that's what
so that,
provoked me.
yeah. Well, I thought it was a fantastic tweet. It was really cool. So if you're not following on Lynn, you or following Lynn on Twitter, you're definitely missing out on some incredible charts, incredible facts, but also every once in a while, some great entertainment. That brings me to a thought experiment. I'd love to get your opinion on this. I've tried to think about this many times, prior to the last wave of inflation that we've had and higher interest rates. But I always thought to myself, okay, out of all the businesses that are out there that people really rely on nowadays, such as Uber would be a great example, how many of these businesses would actually exist if Fed funds had never gone below 5%? And
I,
so do you think Tesla would exist today?
I mean, I think it would exist. I mean, it existed before that time. I don't think it'd be on the scale that it is. I think, the problem with zero interest rates, allows, so what it does is basically when you have no cost of capital, if the cost of capital is roughly zero, basically people monetize other things. It's like you can't hold value in cash, you have to monetize other things. So you pay up for real estate, you pay up for equities, things like that. And the emphasis goes on very long duration assets. And the longest duration asset out there is basically a tech stock, something that,
Right.
if you have a vision that it's going to be super valuable over the next 30 years, even if it's not profitable today, which is, kind of the emphasis of, say, startup investing. That's fine for a period of time. That makes sense while you build up the foundation. But when you have an extended zero interest rate environment, it increases the runway of that unprofitable period where investors don't really care about profits, and that opens the percentage of malinvestments that happen because there should be a feedback loop. If something's not getting profitable over a period of time, something's generally not you know fully right. But if you have that zero rate environment, you're able to push that out much further. And so there's basically an environment where companies are able to be unprofitable. They're able to, keep selling equity at very high valuations, either to pay employees or to, kind of keep funding their operations by always having new investors coming in, a greater and greater number of shares outstanding. Um, and that works until, you have some sort of inflation or higher rates, and you go up. And then basically now that there's actually a cost of capital, if you can get, almost 5% in cash equivalents, suddenly you're going to pay a lower equity valuation for some of these companies. And then the problem is that they lose some of their funding source, because they can't just keep issuing very high valued equity. And then they have to raise prices of their products, basically, to stop, kind of selling at a loss. And then the problem is that their growth rate slows down because some of their growth was only there because they were structurally underpricing their product. And
Yeah,
then,
yeah. If you could explain that in detail, that was fascinating. I think I heard you talking about this with Adam the other day, our good buddy Adam Taggart, and
yeah,
this
so
was
the
a great point.
Yeah, so the problem is, if you make a business selling $20 bills for $10, what is the total addressable market of that business? It's infinite.
Right.
Anyone who finds you is gonna be like, yeah, I'll do that. So you're gonna get tons of customers. Of course, it's only, if you can paint a vision and you get outside investors to keep funding that lousy business, it's gonna grow very big. The problem is that that business now tries to get more profitable, right? And says we're gonna sell $10 bills for, $10. Suddenly your customer base dries up because your customer base is only there because you were actually providing too much value for the price because you didn't have to be sustainable. You had a bunch of investors that were willing to fund it essentially, always with the promise of in the future somehow it'll be profitable, which again makes sense when you're a startup. It makes sense for a period of time, but eventually that you have to start kind of making a sustainable business. And so with a lot of these companies, whether it's DoorDash and things like that, across the spectrum, you have these kind of perpetually unprofitable companies. And in Tesla's case, they eventually got somewhat profitable, in large part because of subsidies, carbon credits, that kind of thing. But essentially, they had periods of time where they were, say, junk rated, didn't have a lot of cash, had quite a bit of debt, were not profitable, but they were able to kind of meme themselves into critical mass profitability, right? You can
Yeah. Well
issue
said.
yeah, issue basically make a lot of promises, inflate the equity valuation, sell a lot of new equity, and then suddenly, that kind of actually damages part of the bear case. That's what happened over the past few years, which is, again, it's fine if you're, painting, I think, of realistic but optimistic portrait of what you're going to do, and you're still sticking within the realm of truth. But when you fully venture out and you're not even remotely close to the things you're building, I think that's where it starts to become an ethics issue.
Yeah, yeah. And it's like the business model goes from their business to just selling equity. And
Yeah,
you saw that with the SPACs too, right? All you needed was a great story, and you just have all this money flooding in. And then whoever's running that SPAC, well, they can charge fees, they can make all this profit. And all they need is not necessarily good business, but just a good story.
yeah. And then when the tide goes out, there's actually a cost of capital. A lot of those go bankrupt. And it's one of those things like lowering the barrier of entry is on its surface a good thing, right? So for example, people can self-publish books now. They don't have to go through traditional publishers, gatekeepers are gone. But it also, of course, means that the long tail of books, there's no filter for them, so most of them are going to be terrible. So
Yeah.
the audience person has to have some sort of way to select the actual ones that are good. And you kind of see that the same thing happens in crypto. If you can issue a security directly to the public for fairly low cost of capital, it
Right.
means the long tail of these cryptos are going to be anything related, scams, frauds, just like things like that, and a very tiny hit rate of something that's actually interesting. And I think you're going to see the same thing with SPACs because basically it's companies in many cases that were not really good enough to have an IPO, but that still came public. So it's kind of like any sort of speculative environment like that is going to have a very high failure rate, and that it's kind of heavily based on that near zero cost of capital environment.
Yeah, but we need those businesses to go bust. I mean, I was talking about with Silicon Valley Bank how most of their depositors were these tech companies. And I kind of went off on a tangent on one of my videos. And I said that a lot of these tech companies are completely unprofitable, that are just incinerating cash. They need to look themselves in the mirror in these higher interest rate environments and just admit that, hey, I guess I am the malinvestment.
Yeah, and it's one of those things, at least at that scale. It's like some businesses might not make sense at a certain scale, but if they were a more niche business and priced differently, then, maybe there's a business there. Same thing with some of these SaaS companies, software as a service. I mean, it's obviously a lot of these companies are providing something interesting. It's just that their estimated total addressable market is often, off by some significant margin because they're not pricing it properly. They're kind of not really focusing on having to do profit because they're able to sell so much equity.
Right.
And so it's either that some of them, obviously some of them, the long tail of the really bad ones wouldn't even exist. But even some of the better ones, the actual size of the market they're going after is maybe not as big as they thought, and some of their advantages over their existing competitors are maybe not as wide as they thought, because the existing competitors are actually trying to make a profit and not rely on selling equity. Whereas if you're in that window where you're able to sell tons of inflated equity, it feels like you're catching up faster than you really are.
Yeah, so we've obviously seen the tide go out. We've seen some entities that were definitely swimming naked, but I don't think we've seen the tide go all the way out, especially if you're putting any emphasis on the yield curve. So, how much farther do you think it will go out? What do you think the next industry is that's going to be most susceptible?
So I still think I think a lot of the explosive part is out. I think now it's a long grind because you can correct them both, either in price or in time. So something can just kind of go sideways for a very long period of time, and therefore lose value in terms of percent of the market, percent of the money supply, inflation adjusted terms, however you want to measure it. Something can just go sideways for 5 years in a big, 30% choppy band. And so I think there are probably a lot of things that are going to go that route. In terms of crashing, I think food delivery, I think that total addressable market is inflated because of some of the stuff. I think, um, commercial real estate, that's, I'm not original to say that. A lot of people are concerned about that area. And the things that these areas have in common is they're either highly leveraged, for
Mm,
obvious reasons. Something is very indebted. If there's very little margin of safety when something's very highly indebted. But then ironically, on the other side of that, if something is entirely based on inflated equity, which is what we just
right.
talked about, where you can be debt free, but if your entire business model is reliant on being unprofitable and always selling more and more shares, you're kind of in the same boat. And an example that is actually back, in the 2014, 2015, like oil price drop, when the midstream sector blew up. If you look at some of those businesses, their revenues actually didn't drop by much. In many cases, even their profits didn't drop by much. If you look at some of the bigger ones, but they still got crushed. And the reason was that they were using kind of that Ponzi finance model, right? So if you look at, say, Kinder Morgan, their actual fundamental business was not very heavily impaired during that whole period. I mean, it was somewhat, but it wasn't like what you'd expect when you look at the stock price or their dividend. It was that they were so reliant on constantly issuing debt, constantly issuing
Mm,
equity, that as soon as that dried up, that the relatively modest contraction in the underlying business resulted in a much larger contraction in the finances of the
right.
business. And they had to cut their dividend, they had to sell off some assets, they had to restructure and get back down to actually a more sustainable business. And I think you're going to have to see that in a lot of these industries still, that they're still unprofitable. I think they're still going to have this long grind of just bad returns.
Yeah, I was talking to Patrick Seresna the other day about, 'cause he's more of a trader, and I asked him what he's looking for as far as signals that would prompt him to go ahead and short the S&P by buying puts or whatever. And he said one of the key components is you've got to look at when the yield curve is no longer inverted. You got to look at when the Fed starts dropping rates, because usually once they start dropping, the market doesn't rip higher. It usually has far more downside before it starts to make that V-shaped recovery. But another thing he said is corporate profits starting to really take a hit. And he said he expects corporate profits for, I'm trying to think exactly what he said. I think for March and April to maybe remain strong. But he said the next corporate profit season or reporting season, he said look out for those profits to start going down, and that could be another red flag or another signal that those traders out there might want to think about going short the S&P. At least that was his thought process. What is your view on that?
So I think that's a good way of looking at it. I do think corporate profitability is pressured. I think the one challenging aspect is that in a more inflationary environment, the fact that nominal revenue can still be growing,
Yeah,
can
right,
be
right.
tricky. And I did an analysis a while ago. It's probably like 6 months or more ago. I looked back over the past 100 years at all the inflationary spikes we've had, and I looked at what corporate earnings were doing during that time. And more often than not, when you had a big inflation spike, usually, earnings were kind of sideways, which is
In
which is
nominal terms?
yes.
Huh. Okay.
which is not good in real terms.
Right.
Basically, it shows that their costs are going up as quickly or more quickly than their top line. And of course, there was a range there. Sometimes earnings did better, sometimes they did worse, but generally you didn't have like large drops in earnings. Um, and so that's the challenging environment where again, I think you can kind of have a period of flat earnings for a period of time. You can get a mild contraction in earnings. Obviously, there are certain things that could get bad enough to actually give you a big drop in earnings, but that would be outside of my base case. It's that, I think that the way of looking at it is that earnings are not likely going to be positive. And we'll see as more data points come in and what policymakers are doing, how negative we're talking about. Are we talking about sideways? Are we talking about down? Are we talking about, mildly positive in nominal terms, but negative in real terms? There's a bunch of ways to look at it, but I think that they're near the top end of their profit margin range. That they've already rolled over from that perspective, and I still think we're going to be in a lackluster environment for corporate earnings. And that can, if you look at things like the S&P 500 to gold ratio, that's been showing signs of kind of structurally rolling over. If you look at some of those bigger charts, like monthly charts or quarterly charts, because basically you're kind of looking at like say a hard money metric for something that's very dependent on profitability, very dependent on cheap labor, globalization, all these variables, all these efficiencies. And if any percentage of them are challenged, either because of U.S. China tensions or shortages of labor domestically, or inflationary material prices in some cases. There's all sorts of factors that can influence different industries.
Yeah, that's like my exact view of the housing market. That basically it could go sideways, and it most likely will go sideways, maybe down a little bit in nominal terms, depending on how a recession plays out, how significant it is. But even if it goes sideways for the next 5 years, if on average you've got 5, 6, 7% inflation compounded over 5 years, that's a big number as far as a decline in real terms.
Yeah, I agree, and that's how I'm viewing it. And you cover real estate more closely than I do, but looking at certain linear markets or just nationwide averages, that's generally how I see it as well. If you go back, again over 100 years of data, looking at say like Robert Schiller's data, for
Mm,
example, on housing, there's only really been two very very large drops nationwide in terms of housing prices, and that was the Great Recession. And before that, the Great Depression. Those are the big, like say, double-digit drops in nationwide averages,
yeah.
basically big disinflationary or outright deflationary, debt crises. Um, but now, because we're in a more inflationary period, because a lot of people locked in and don't want to sell, things like that. When I look at least one of some of the more linear markets, maybe outside of some of the the bubbly markets from whatever peak they were at. But if I look at a linear market, I think a lot of these look like they're kind of setting up for a multi-year choppy period. Could go a little lower, could grind up a little higher, but the inflation adjusted results are unlikely to be good for quite a while.
Yeah, I always say that the prices need to get back down to where they were in 2012. And because that's kind of our historic average adjusted for inflation going back to 1900. And everyone freaks out when I say that. Oh, that's impossible. There's no way it's going to happen. And I say, well, just think that one through. If nominal prices go down by 10% in the next 5 years, and we have, let's say, 7% inflation, you're there. You're
Yeah.
there. And that's what people really don't realize.
Yeah, I think a lot of people look at things either up or down.
Right.
It's always at the extremes. And there are, I mean, especially in inflationary environments, there are periods of just going choppy and nowhere. And I think looking at emerging markets as like a historical note is useful, because some of the things that developed markets are going through now have emerging market characteristics, especially if we have
Mm,
another kind of commodity spike, for example. Let's say we try to accelerate out of this recession, we cause another inflationary problem. Basically we have kind of sovereign debt bubble issues. We have energy things we can't print, like all these kind of things that are more characteristic of emerging markets. And when you look at them, often their equities and their house prices don't do poorly in their local currency terms. They do poorly in dollar terms, they do poorly in gold terms, things like that. And I think it's a somewhat less extreme version that we're seeing in developed countries, where things might not do particularly poorly in dollar terms. They might just go sideways in dollar terms. even though, in terms of purchasing power, in terms of, gold terms, whatever the case may be, they're actually doing quite poorly.
Yeah, so let's talk about that a bit. Let's talk about, you're someone, and I've kind of ridden on your coattails here after you made this point because it made a lot of sense to me that the 2020s will most likely be more like the 1940s compared to the 1970s. And so let's go through that and then go through kind of what the trade deficits look like. And then let's go through kind of the rest of 2023, but then the bond market. And, the bond market is very interesting to me right now because when I listen to guys like Luke, it totally makes sense that there's in the future, there's probably not going to be a lot of demand, or there could be a setup to where there's a lot less demand for treasuries, right? Especially relative to the amount of treasuries that Janet Yellen is supplying. Because I've looked at charts that show over the past year and a half or so, really your only net buyer is U.S. retail. So if they go away, then who on earth is your net buyer there? And do interest rates skyrocket? But then on the same token, or on the other side of the coin, you've got the fact that the front end of the curve, there's massive amounts of demand, and right now, as we speak, there's probably a lot of demand for the long end too, considering how the 10 years at 3.4 and Fed funds is call it at 5%. So it's weird. It's like I see this macro setup to where there could be a lot less demand for treasuries, but currently it seems like there's massive demand for treasuries. So I know it's about 5 questions into one, but I guess why don't you start by outlining kind of the difference between the 1940s, 1970s, and what we might see today?
Sure. So I'm finding that and I've been talking about this for a while, that I think the 1940s are the closest analog we have. It's obviously not a perfect analog because a lot of things were different back then. But basically, if someone is completely unfamiliar with the macro environment of the 40s, they're kind of at a disadvantage, and they're going to find more things to be unprecedented in this environment than they would be if they at least had that benchmark to compare it to. And so, if you start at the 70s, back then, the inflation was largely driven by bank lending.
Yeah,
So
this is key.
yeah, so most of the money creation was bank lending, and that was because the baby boomer generation was reaching their home buying years, and so you had kind of that peak early consumption period, and then you add to it obviously, 1970 U.S. oil production peaked after like 100 years from the late 1800s all the way up to 1970. It was just almost always going up, but it structurally peaked for multiple decades until the shale revolution in the 2000s. And so we became more reliant on imports. And obviously we ran into geopolitical conflicts and shortages from that. So we had kind of that combination of bank lending driven money supply growth, which was above trend, combined with, real world shortages. And the fiscal situation was not helping. You had going into that, you had the Vietnam War, you had the guns and butter, the domestic Great Society programs. So you did have fiscal deficits, but they were not very large as a percentage of GDP, and they were a smaller contributor to money supply growth than the bank lending was.
Right.
That was peak bank lending, and so and also debts were very low as a percentage of GDP. Both, private debt was pretty low, and public debt got as low as 30%. Federal debt to GDP, because you had kind of a multi-decade period of some degree of financial oppression, basically yield spending half their time below inflation, very strong underlying growth. And so they, from the 40s to the 70s, they got debt very low. And so when they encountered the 70s, the policymaker tool was try to slow down money supply growth, try to get back to positive real yields, which you could do because debt was so low, and then go out and try to solve some of the geopolitical issues to get oil flowing again, and clear up some of the supply chain bottlenecks. There's really a multi-pronged attack to try to solve that inflation problem. Whereas when you look at the 40s, the inflation was roughly the same magnitude throughout the decade. It actually reached a higher year-over-year peak. It wasn't quite as persistent. It came in like these sharper waves and contractions. Um, but a lot of it was driven by fiscal spending. Banks were not lending almost at all, and instead, because of the war effort, and because some of the social kind of dynamics of the time, there was very large fiscal spending. And we think of it as the war, but a lot of it was building manufacturing facilities, building energy facilities, getting commodity access. Um,
Mm,
and they also, after during the early stages of the 20th century, right, there was that kind of growing divide between, say, communism over in Russia and then capitalism over in here. And there were kind of growing communist sympathies, especially with kind of rough worker environments, industrialization, things like that.
yeah.
And for example, after World War One, when veterans came back, they kind of just gave them a bus ticket and said, thanks for your service, and sent them on their way. Whereas they didn't want to repeat that in World War Two. They wanted to, not have that kind of disgruntlement in society. And so they also then used the money to put 8 million people into technical school and college, the GI bills, and then set them up with subsidized mortgages and kind of all these ways to kind of try to build a middle class. And so this was a very large fiscal driven inflationary environment. And so that was a huge increase in money supply, huge increase in inflation. And the problem was that debt to GDP was so high, federal debt, that they couldn't afford super high interest rates. You'd have a debt spiral. And so they just held rates low anyway. They inflated a lot of the debt away. And that actually helped keep deficits lower than they otherwise would have been. The problem is if you have very large deficits, very high debt, and you have very high interest, you have a spiral. You just, if you look at, say, like a junk rated company, if they have very, very high debt, if they have high interest on their debt, and they're not very profitable, eventually they're going to go bankrupt. Or if they had the capability to print their own money, they would not go bankrupt nominally, but they would hyperinflate their their units. And so that was kind of the difference between the 40s and the 70s. And the problem is that here in the 2020s, in many cases, we resemble the 40s. So it's not excessive bank lending over the past couple of years that triggered all this money supply growth and inflation. It was the large fiscal expenditure. And people often think of the stimulus checks and the child care tax credits, but it was also, the PPP loans that turn into grants. And there's been studies on those that show, something like two-thirds of it wasn't even used for paychecks really. It just went to the bottom line of like wealthy business owners in many cases. So they would just get like a $500,000 handout, for example.
Right.
It also went to large corporations that often didn't really use it for employees. It just kind of goes to the corporate bottom line. So kind of across the spectrum, there's this very large period of money creation. And the problem is going forward due to kind of persistent military expenditures, and due to structural, just the way we've done entitlements for decades now, we have these large structural deficits going forward. And as you pointed out, not exactly a lot of balance sheet capacity to place them. And so I
I,
guess, go ahead.
you know what I'm thinking, Lynn, as you're discussing the 1970s, do you think the reason M2 was able to increase so much due to bank lending and they didn't need that fiscal component is because we had so many decades that were inflationary, and then we had kind of the middle class growing in, or at least real wages, I would assume, getting higher in the 1950s and 60s. Going into the 1970s, you have this environment where real wages had probably grown a lot and there was very little debt on the consumer balance sheet. So there was a lot of balance sheet capacity for the consumer to take on all this debt that the banks were more than willing to provide. And that's that environment, that's kind of that setup for that M2 money supply increasing, leading to a lot of inflation.
Yeah, they went from relatively underfinanced to fully financed. So money
Yeah,
supply growth is growing faster
yeah,
than GDP. You kind of see that when you see a developing country kind of go up the GDP per capita spectrum. You see, very little banking access, and then over time they get more and more banking access, and so you actually have a pretty strong period of money supply growth. That was kind of
yeah,
what we went through in the
and
70s, and then it's also, and that was kind of pre. We didn't have that big burst of globalization yet, and so if there was more demand, a lot of that would go into worker wages. There's also, you kind of have these, the power structure between capital and labor tends to have this pendulum effect where it goes back and forth. So, going, like we talked about before, in the early 20th century, generally capital was very well positioned. So, there was not a lot of worker rights. There wasn't a lot of unionization, but there was kind of then pushback against that. FDR, all these kind of multiple decades, and so you got more unionization. It kind of gave labor more and more power to collect more wages. But like most things, obviously the pendulum goes too far. and it got kind of oppressive in that sense. And so that's another thing they did to try to combat inflation was they did union busting, they accelerated globalization, more things opened up. I mean, China kind of opened up in the 90s. Obviously, you had the end of the Soviet Union as it was, and so that opened up more pools of labor. But yeah, basically in that kind of middle 20th century period, you kind of had near the height of workers' ability to collect more wages, which had that kind of cycle of inflation.
So now we're going into deglobalization, but we're also at a period, I think, just in the last 2 weeks or month, where bank lending has started to decline. And I've paid a lot of attention to this because M2 and M1 have been declining for about a year. You know better than I would. And a lot of people thought that okay, that means that the consumer balance sheet is decreasing. But when you actually scratch beneath the surface, you see that a lot of that is probably money market fund. There's trading savings for money market fund and maybe trading savings for treasuries, which go into the TGA or used to pay off the Fed or something like that. So it's taken out of M1 and M2. But what I was really looking at, hyper focused on, is if M1 continues to go down, while at the same time bank lending goes down, now all of a sudden it may mean that they're not trading one asset for the other, but that their balance sheet is actually shrinking. So if that is true, I'd like to get your thoughts on that. And then if you agree with that, or maybe you have some different insights, how would that play into kind of this inflation, deflation, disinflation debate right now for the rest of 2023?
Yeah, so I think you described it in an accurate way. A lot of that was trading one type of money for another type of money, more
Yeah.
or less. Also, obviously, quantitative tightening was an element. If you do QE or QT, with banks, it doesn't really have much of an impact on broad money. But if you end up buying or selling assets to non-banks, even if you're just using banks as the intermediary, if the ultimate kind of source that you're buying or selling from is a non-bank
Yep.
entity, that does impact deposits, broad money supply, that kind of thing. So the combination of quantitative tightening and the shift in the types of cash equivalents that people are holding has impacted that. While bank lending was still reasonably strong, but as you point out, now that we're seeing signs of bank lending contraction, in many cases out of necessities, because
Mm.
for the first time in a while, small banks are generally reserve constrained. They need certain liquidity levels. They're back to very, very low cash levels as a percentage of their assets, as a percentage of their deposits, more so than large banks are. And so they're really restricted in the type of lending they can do now, and they're obviously more risk averse. Um, and so all of that is now, I think, it continues to be disinflationary. So, a lot of people often ask, how long until they get back to 2% inflation? Whereas for me, that's the less interesting in question than whether or not the underlying causes of inflation are structurally solved or not. Because if you go back to either the 70s or the 40s, inflation came in waves. It would go to very high levels, and then there'd be a period of pushback. It could be because that they did price and wage controls. It could be because they temporarily reduced the fiscal taps. It could be because the central bank was fighting back. There's all sorts of reasons why you get those pullbacks and disinflation. And I think we're in one of those now, obviously.
And I want
There's
to
still,
point out too, the 1940s was far more extreme than the
yeah,
1970s.
Yeah, you go from double digit inflation down to literally negative inflation, to double digits again, and then down to
Yep.
negative again, and then up to like 9%, and then down to negative again. And the average for the decade, it was on the same ballpark as the 70s, but it was at a very extreme level. And the highest peak year of year was something like 19%, which actually exceeded the highest peak year of year in the 70s. But unlike the 70s, there were those periods of deflation. And so there's still wild cards, obviously, from what's going to happen with the oil price, OPEC, China, that kind of thing, because that can catch us off. That's why, going back to the emerging market comparison, you can have recessions that are still inflationary in emerging markets because they have these dynamics that they can't fully control. And I think that we could encounter periods like that here in the U.S. or Europe, where we have external shocks, supply side shocks that say give us inflation despite slow or negative economic growth. Now, right now, oil price is still in a pretty attractive band. and we have all these other things that are contracting. So I think it still looks disinflationary for a period of time due to some of those forces you mentioned.
Why do you think OPEC cut? Do you think they cut because they see demand declining, or just to stick it to the Biden administration to create inflation? What is your view?
My read's a bit of both, but I'm relying on other, there's geopolitical experts, there's reporting from the Financial Times, for example, that try to cover some of the behind the scenes reasons for that. So it's not fully clear, but what is clear is that Saudi Arabia has been moving a little bit eastward in terms of
Right.
its connections. We'll see to what extent or how persistent that is, but that's been a pretty clear trend. Um, and we the U.S. wanted to take the edge off oil prices by reducing the SPR. But when oil prices got cheap, they didn't exactly take initiative to refill the
Right.
SPR. So and I think when you add softening demand in the United States, I think Saudi Arabia was like, well, why not? Why not cut a little bit and get the price back up? And if demand comes in softer than we thought, at least we already did a cut, or at least we'll gain more leverage with Washington and see where that goes.
Yeah. Yeah. Okay. So the next topic before we get to that, because that's going to be a big topic, what do you think about demand for treasuries? Because Luke's argument well, and it makes a lot of sense. And like I said, when I look at a chart showing that over the last year and a half, the only net buyer of treasuries has been retail, but then you try to reconcile that with the front end just having massive demand, and then the 10-year and 30-year being so far under Fed funds. Where do you think does it? Am I right to assume that right now there's a lot of demand for treasuries? Let's start with that. And then if so, where do you see that in a year or two? Could we get to a point where we go from a lot of demand to almost no demand?
Yeah, there's certainly a lot of demand for the short end of the curve. That much is clear. There's a shortage, which is I did compare this incident somewhat to the September 2019 repo spike because you had a similar period of bank cash running down to pretty low levels. But the main difference there was that back then there was an oversupply of T-bills, whereas here, if anything, you have the opposite problem. You have undersupply of T-bills. So there's virtually no shortage of demand for T-bills. And if the federal government were to shorten its average debt duration and issue a ton of T-bills, assuming it gets the debt ceiling resolved one way or another and it's able to issue its debt again, if it really just kind of focused on the front end of the curve, they would probably have no problems, issuing tons of that, sucking money out of
Yeah.
reverse
Yeah,
repos.
Janet
That
Yellen actually talked about that. I remember she called it like a debt buyback or something like that.
Yeah, you can do things like that. I think the long end is more fluctuating. So, some months there's pretty good demand for it, other times there's not. And the bigger problem is, as you pointed out, that retail has really been the buyer there.
Mm,
And banks are unable to really buy when their deposit base is flat to down, and they're already actually pretty cash constrained. The cash as a percentage of their assets is back down to where it was in 2019, well, at least for small banks, and for large banks, it's not much higher than that. So they're not exactly the big buyers that they were. Right now, they're net sellers. Um, and if you look globally at dollar demand, a lot of people look at obviously the headlines of bricks bucks or geopolitical stuff, but the more tactical thing is dollar strength. Generally, when you have a very strong dollar, somewhat unintuitively you get less foreign demand for treasuries, because if
mm.
anything, they're defending their currencies. They might even be selling treasuries to get dollars or to
Oh yeah.
backstop their own currency. So you actually see a pretty strong inverse correlation where they're not really accumulating treasuries when the dollar's strong, and only when the dollar takes a pretty big dip do you start to see reserve accumulation again and more dollar increases. So as the dollar has
Mm.
been in this pretty strong band, really since that 2014 2015 timeframe, you've not seen a lot of dollar treasury accumulation by the foreign official sector, and only modest amounts by the foreign private sector. and it kind of ebbs and flows with the dollar strength along the way. And then when you zoom out and look more geopolitically, China's already declared that it's ever since they launched the Belt and Road Initiative, that's basically where they want to put their dollars. They don't want to put them into treasuries. They want to put them into loans. You see some degree of reserve diversification. You see kind of renewed gold demand. Basically, just that kind of the geopolitical aspects that are somewhat different than that tactical cycle. So when you take banks out of the equation, and when you kind of take the foreign sector out of the equation, it really only leads domestic non-banks, and they
Yeah.
obviously only have so much domestic,
But also,
balance sheet
but also
capacity.
too, Lynn, I would argue that the reason that they traded those savings for treasuries was because the delta between what they were getting on that savings account and Fed funds was so extreme due to quantitative easing. But right now, I mean, what you're saying that banks are having to start to compete for deposits again, which means they're going to be paying more and more and more and more for those deposits, which most likely means that the delta between what they're getting paid in a bank and what they can get in a T-bill or a treasury 10-year, let's say, really starts to decrease to a point where it might be non-existent. If you combine that with the fact that the Fed may be lowering rates to decrease that delta again, then you may go into this situation where the whole incentive for them to trade savings for treasuries is no longer there.
Yeah, I think that's the longer term story. I think the delta is still pretty wide.
Yeah.
So there's still a pretty big gap between now and then. If you look back at prior tightening cycles, it's interesting because deposits never really move much in the prior cycles. You'd have
Yeah, but that's because there's no QE because the savings rates would go up with the Fed funds.
Well, yes, but I'm saying that even if you look at, say, bank rates, so bank deposit rates, they wouldn't, on average, move. You'd have some outliers move, but the average bank rate wouldn't move much. And I think a lot of it was that it was temporary. A lot of people don't look at their bank and shop around. There's high switching costs. They just don't really kind of quickly shift to other types of assets. Whereas in this time, the perception that they're going to be higher for longer and the recent perceptions around bank safety has led to more of an exodus. And so now this time there's more of an incentive to have that bank deposit rate catch up. And if you asked me a few months ago, I would have expected it to be slower. But obviously some of these recent things, the weaker banks, as well as the perception that it's going to be with us for longer is accelerating that trend compared to prior hiking cycles. So yeah, if that gap closes to a significant degree, then I think that some of that retail bid for T-bills diminishes.
Or the long end. And what I was referring to, Lynn, is I did a whiteboard video the other day where I was actually researching this topic, and I saw that for checking accounts, it seemed like there wasn't a real strong correlation between the amount banks were paying on checking deposits and Fed funds. But when I looked at savings deposits, that's where the savings deposit rate that banks were paying was very consistent with Fed funds. In fact, right off the top of my head, I remember a chart I got. And I'll send it to you later. I think it was from J.P. Morgan. Josh, you can correct me if I'm wrong there, but it showed going back to like the late '90s what $100,000 in a savings account would get you as far as annual interest compared to the stated CPI. And like I remember 2006 specifically because you were getting like $6,000 annually to have $100,000 in savings, and the CPI was like I don't know, it was 3%, so you had a very good real return. But then when they did QE, that savings rate just dropped straight down to like 25 basis points or something like that. So anyway, I'll have to show you those charts because my concern, like I said, is that okay, that delta decreases, and now all of a sudden there's no incentive. Then who's your buyer? And you combine that with the fact that although we've had an inverted yield curve, the curve for banks that they care about, their lending cost has been very, very low. So their curve has actually been steep. You know what I mean? So what
Yes.
happens when their curve actually inverts?
Yeah, that's going to be negative for bank capital, negative for bank lending, and it's the how much it impacts a bank will depend very much on the type of bank. I mean, I'm not bullish on the long tail of small and medium banks. Certain banks I like are generally the larger banks. Um, And so, there's still areas that are interesting, but for the most part, I think banks are going to be highly pressured by that because even if their deposit rate just goes up to 2 or 3%,
Yeah,
that
that,
already that cuts off a lot of their net interest margin compared to the fact that they're holding a lot of these longer duration assets that are at 1.5, 2% yields. Now they are getting very high rates from their reserves.
hmm
So their sources of capital and any sort of new loans or new securities are paying pretty well, but they have this kind of long, like a large basket of these legacy longer duration assets. And when we talk about the Fed hiking cycle, one of the challenges is just how quickly they did it. Like if you do it over a period of time and some of those older bonds can mature and get reinvested at higher rates and things like that, it gives banks time to have their assets and their liabilities go up together. Whereas
right.
if you raise rates at a record pace, I mean it's the fastest hiking cycle in absolute terms since the 70s, but in percentage terms, it's the fastest ever. And that puts quite a bit of pressure on these banks that have these longer duration assets.
Yeah, for sure. Okay, so let's talk about de-dollarization. That's a super hot topic right now. What are your views?
So it's not the most like headline inducing answer, but I'm somewhere in the middle, and it's on one end of the spectrum, you see basically people say, oh, this is the end of the dollar. This is it's all over now. It's going to be like BRICS currency, yuan, whatever the case may be. The problem with that is many people pointed out that these headlines have been around for like 2 decades. Every time there's kind of an interesting currency deal, you always have these like magazine covers like end of the dollar and this is it and like this is the end of everything. So
Yeah, would you hear Tucker Carlson come out and talk about it the other night on Fox News?
I saw that CNN mentioned it. I saw that Fox had a segment on it. I did think I see that Tucker also did. So I guess Fox now has had two different segments talking about it.
Yeah, I
Um,
tweeted out that the only thing we need now is to see Matt Damon, Tom Brady, and Jim Cramer talk about it, and then you really got to buy the dollar.
yeah. So yeah, I'm definitely going to fade that extreme.
Yeah.
Anything that's the idea that things are going to move very quickly, things like that. On the other hand, I'm also fading the idea the people that are basically saying, "Oh, nothing's changed. We've seen these headlines before. It's totally the same as it's always been." Because there obviously have been certain accelerations that make this particular cycle different than prior cycles.
Yep.
These things do tend to go, and it's so if you look at, for example, obviously the war has been a large impact. The fact that Russia's reserves could be frozen, and they already had ahead of that de-dollarized, but they didn't seem to expect that their euro assets would be frozen. I guess they didn't think that Europe had the guts to do that, given how much natural gas exposure they had to Russia. So basically, when countries look around and say, wait a second, is that maybe that's not as money as we thought it was. It's more permissioned money. Maybe we should diversify. So there are things that have changed. Also, the sheer size of China. People are talking about like headlines from 2004 or headlines from like 2008 or whatever of these kind of attempts at de-dollarization. China is rivaling the U.S. in terms of economic size now in many categories. I mean, they're the largest commodity importer. They generate more electricity. They have more skyscrapers. They're the largest trading partner with the majority of countries in the world, which
Mm.
2 decades ago used to be the United States. There's only a handful of metrics where the United States is still firmly, a larger economic presence. I mean, we're still a larger, obviously, deep water Navy presence. We still have, obviously a larger capital markets, larger, a bunch of things like that. But now there's kind of two economies that, depending on what you're looking at, are roughly the same size. And in some areas, one's bigger, in other areas, the other one's bigger. And so there's clearly a gravitational force that gives them some degree of rivalry. Now, they're not much like the dollar is not really big enough to kind of serve the whole world anymore. It's also true that China's not really big enough to serve the whole world. They have demographics issues. Their capital accounts aren't even open. They don't exactly have a very strong like reputation globally. If you go to a street in a random city, they want dollars, not yuan.
Yeah.
So even though there's been de-dollarization to some extent around the margins at the central bank level, it's not really on the public level, at least not yet. And so I think the way that we're pointing towards is obviously some degree of multipolar, um, like a multipolar world where reserves are more diversified, payment channels are more diversified. There's obviously better technology now than there was 10 years ago. They're kind of developing these, interlocking CBDCs that can allow, more decentralized exchange, things like that, as well as gold. Obviously, is kind of the neutral force. And so, with the combination of all these technologies, even if the dollar is still the unit of account for a lot of things,
Hmm.
out of network effects and convenience, just the sheer fact that you're diversifying both reserves and payment rails changes things quite a bit.
Yeah, very well said. The way I've tried to describe it on my channel is going through a thought experiment of what do you think the headlines would have been in the 1920s, or if we had social media back then, what do you think people would have been saying about the British pound on Twitter? They
Yeah.
they probably would have been pointing out the exact same things, and I'm sure the exact same things were happening because that's when the United States economy was getting to the same size as the UK, and that's when those businesses started to want to hold more and more dollars because they're doing more and more business with us, but the reserve currency status wasn't formalized until 1944. So it's just that transition, it definitely takes place, but it just takes place over a long period of time.
Yeah, and 2 points I'll add to that. One is that when we go back to my 1940s comparison, one of the key differences is that back then the US had a structural trade surplus. We were the rising power, we were the industrial base.
Yeah.
And whereas the UK had a structural trade deficit as the existing world reserve currency, the existing incumbent. They had that, kind of more structural trade deficit. So in many ways, the United States looks like the UK did really from the
Mm.
1940s. Um, and the second factor I like to point out is that having one country's currency be the reserve currency of the world is actually quite an anomaly. So a lot of people they see a chart of like the reserve currency changing every 90 years on average. They see,
Yeah.
okay, before it was the U.S. and before then it was the UK and before then it was Netherlands and before then it was Spain, whatever the chart goes. The thing that you have to keep in mind is that it's like before the US, it was like gold, and before then it was like gold, and before then it was gold, and it's like all these different flavors of gold or gold and
Yeah.
silver, right?
Yeah.
So,
Yeah. Yeah.
you'd have kind of promises to pay for gold. And also, when they talk about reserve currency of the world, they often meant reserve currency of Europe. They weren't, it wasn't, until you got to the UK, he didn't really have a truly global reserve currency. It
Right.
wasn't like, the Spain or Netherlands, like their currency was like the dominant currency for like China, for example, if you go back that far. And so, this kind of period ever since Bretton Woods where, the world was devastated, the United States was like over 40% of global GDP. We had almost all the gold. We had, our land mass was almost entirely untouched by the war, whereas everybody else, winners and losers, were devastated. We really had, all the cards. We had a chessboard full of queens, and we could kind of set all the rules. Whereas just a return to normalcy brings us out of that anomaly. We've had kind of this better part of a century of that anomaly slowly kind of returning back to a more normal environment. China's kind of if you go back long enough, China was a very large percentage of world GDP. So was India. And they went through a period, during colonization, due to a bunch of factors. They had an unusually small share, and in many cases, they're just kind of returning back to the general percentages that they always used to have. And I think we're just kind of returning back to a more diversified baseline economically, and I think that's going to eventually result in more diversified currency exposure as well.
Yeah, that makes a lot of sense. So how does gold play into that? How does Bitcoin play into that?
Well, so gold if you look back from the 70s until 2008, the central bank holdings of gold were generally diminishing. And at the Treasury, the dollar was taking the center stage there. Ever since 2009, you've had like a V-shaped recovery in gold tonnage owned by central banks.
Okay.
We kind of hit peak, like disregard for gold and going into dollars. I think a lot of countries like, wait a second, maybe the dollar is not quite as bulletproof as we thought it was. Maybe we want to have self custody of something that's a little bit more inflation resistant, more scarce. We fully control it. Obviously, you had certain countries spearhead that more than others, like Russia. They had more of an incentive to want to have their own gold for obvious reasons. Um, and so ever since 2009, gold's been kind of reasserting somewhat its place in global reserves because it's the one type of money that they can hold in large amounts. They can avoid counterparty risk, and of course the problem is that it's slow and clunky to settle. But for a certain percentage of their reserves, it makes quite a bit of sense, and it's neutral money. So I think as all these other payment arrangements kind of get built, and we'll see where that goes. Gold continues to be one of the most reliable things that they have. For Bitcoin, the problem is that it's not big enough yet. I mean, when you
Mm,
talk about the size of global oil trade alone, let alone global trade for all goods and services, if you're trying to figure out what unit of account, what settlement medium that you want to do that in, Bitcoin is hundreds of billions of dollars in market capitalization, trillions of dollars in annual uh, transfer volume, whereas the sheer scale you need is many, many trillions. It's still
right.
small enough that like a corporation or a billionaire can move the price for periods of time. And so I think you need a higher level of adoption and depth of liquidity before that would be interesting on the sovereign settlement and reserve level. Also, if you had higher adoption, you probably would have less volatility. And if you kind of reach the upper end of the total addressable market, it would go up and down more slowly, and therefore you'd have less leverage, less incentive to build leverage on top of it. Kind of like how a lot of people don't go like super levered long gold in the
Mm,
way that some people went super levered long, say Bitcoin. And so I think as that settles and as that gets kind of a larger liquidity, larger adoption, that could become more interesting to central banks over time. I would expect it to. But right now, it's still early, and a lot of central bankers face career risk. I mean, if they're the one that convinces people to put a little bit of Bitcoin on their balance sheet, and then it has one of its like 80% drawdowns, they're fired.
yeah,
So,
right, right.
it's still early for that, but I think that actually is a long-term thing because it opens up not only that independent reserve asset, but also the independent ability to send or receive money, to any other entity with an internet connection.
Yeah, I've tried to think through that chicken or egg type issue with Bitcoin is you need the adoption to decrease the vol, but you need the vol to go down to increase adoption. I try to figure out how you could increase that adoption while at the same time the vol was kind of what we've seen. I guess the answer is it just happens very slowly.
I think that's it. I think it's time. I think you
Yeah.
just, it's gone through, 4+ cycles now. I think it's probably going to keep going through cycles where, each time you get a kind of a higher high and a higher low.
Hmm.
And I think that's basically it right now it self-selects, especially during bear markets for people that don't mind the volatility. That they say, okay, here's my assets, and this percentage of my assets I'm willing to put into something for 5, 10 years and
Right.
not worry about the volatility. That's really the only people that can make use of it for that purpose. There's other people that are using it to get in and out of say stable coins and using it for payment rails and using it as part of their assets. Um, but I think that over time, it's until it reaches more people, and that's kind of a slow process. That's how it goes, and that's also why it's different than other types of technologies. So when you see like say smartphone adoption, you have this smooth rapid growth curve, and that's because it's not a monetary adoption. There's no leverage. It's not like you go levered long an iPhone. Like you get your first smartphone, you never go back. You never say, okay, I'm out of the smartphone thing. I was too levered in it and I'm going back to flip phones. And then whereas something like Bitcoin, you get adoption during a bull market, they get euphoric, and then they go buy dog money, and then they get wrecked, and then they're like, I'm done with all that, and then they wait 3 years, 4 years, and it has another bull run, and like, wait a second, that's not dead, and then they get back into it. And so definitely going to be a longer and messier adoption curve to whatever
Yeah.
extent it eventually goes, compared to something like electricity, radios, smartphones. You just can't really adopt monetary technology with the same type of smoothness.
Yeah, that makes a lot of sense. All right. So for the rest of 2023, what do you think are your top three? I don't want to say predictions because that's tough, but the top three things that you are focusing on for the rest of 2023.
Sure, I would say the number one thing I'm focusing on is the liquidity environment.
Mm,
And so, during 2022, the Federal Reserve was doing their quantitative tightening, so they were reducing their balance sheet. But especially in the second half of the year, this was somewhat offset by the Treasury general account, which was emptying its cash reserves back
Right.
into the market.
Right.
And when you think of it's unintuitive because when the Treasury general account is increasing, that's actually negative for liquidity, and when it's shrinking, that's actually positive for liquidity. And you can think of that as basically an unproductive void. When they either tax more or they issue more bonds at a quicker rate than they're spending, they pull
Mm.
money into this void, and that's money that's sucked out of the financial system and it's not yet redeployed into the financial system. So it's in that void, and the bigger that void is, that's kind of negative for liquidity. Whereas when they hit a debt ceiling like they have now, they're unable to issue new debt. Taxes are only coming in so quickly, and so they're spending more than they're bringing in, and so they're drawing down that Treasury general account, which is actually pro liquidity. It's going back into the financial system, and it's offsetting quite a bit of the quantitative tightening that we've seen over the past period of time. And right now it's already pretty low. It's under 200 billion, um, and it's had a multi-hundred billion drawdown just in the past 6 months.
Right.
And when they reach a debt ceiling, maybe early summer, I mean, we'll see what happens with obviously certain tax revenues are unpredictable. There's a lot of factors that can influence it, but one way or another, when they eventually solve the debt ceiling and they want to refill their Treasury general account from will roughly be zero back up to their, presumably they're targeting half a trillion. That's kind of their baseline that they go for now. You'd have basically Federal Reserve quantitative tightening alongside Treasury general account also filling up, which is negative for liquidity. And I think that's where all these concerns around recession and liquidity really come to a head, because if the Fed blinks and the Fed's, if the Treasury tries to fill up and causes a liquidity problem, and the Fed has to end quantitative tightening and maybe even do QE, or just at least be neutral, that's kind of a regime change. That's a change in terms of monetary policy. So I think we have to, that's like a set of landmines that we have to navigate and be aware of this year. And rather than try to predict exactly how it's going to go, instead, what I'm mainly doing is emphasizing that particular chain of events to look out for. That
Okay.
that basically whatever this year shows, it's likely not going to be linear. It's likely going to be periods of volatility, because you're not going to have that same kind of structural force of Fed balance sheet down, Treasury general account down. Instead, these are going to kind of run into each other rough in the middle of the year, and we'll see how that goes.
Yeah.
Um,
Then you got the variable of reverse repo too.
Exactly. And then yeah, then the question is, does when the treasury wants to refill their cash account, do they issue a lot of short duration T-bills to try to suck money out of the reverse repos? In which
Right.
case they actually might be able to refill without causing a problem. On the other hand, if they issue a lot of normal duration, that's where they could cause quite a bit of liquidity problems, because it likely
Hmm.
wouldn't be coming out of reverse repos. And so basically that's a set of human decisions we have to look out for. How's the Fed and the Treasury going to interact over the next 6-12 months, is probably the single biggest thing I'm watching. Number two is I'm looking at commodity and especially energy prices to see if oil can stay over some of its recent lows, if it can start making higher highs. I'm looking also at things like Chinese international flight levels.
Mm.
So, when China opens, it doesn't open all at once.
Right.
Domestic flights came online quicker. There was a lag for international flights. I've seen a lot of reasons for it. Some people point out that, I mean, a lot of pilot licenses like expired. A lot of that infrastructure doesn't just turn on a dime. Um, there's also, for a period of time, they had a COVID wave going through their, it's kind of like pulling a band-aid off when you reopen after a long period of suppression. It was going through their population. You had a lot of countries, they were pretty open with their borders, but not to mainland China, because they were kind of the exception at the moment. So there are a bunch of factors that I think take time for these international flights to ramp up, and we're seeing in data that it is ramping up, just not as quickly as domestic flights did. And so that's like one of many oil demand factors.
Mm.
That I think are worth keeping an eye on. So I am watching things out of China. I'm watching oil price for technical signals and support signals to see how much of a variable that's going to be on inflation. Because as we discussed earlier, I generally think that there are still a number of disinflationary forces in the economy for at least a period of time before we get back to a period of inflation. But the big wild card, and one of the factors that contributes to my long term inflationary thesis, is that I eventually expect higher oil prices. And I don't really know the time frame, because if you have a severe recession, you can delay that.
Yeah.
But if there's enough international demand, China, India, emerging markets, just countries like that, you can get pretty sticky high oil prices, even if U.S. demand is stagnating.
Because the
And
supply side's constrained. I mean, that's really
yeah,
a long-term view, right? Or
exactly. Yeah,
thesis.
yeah, because there's only so much investment, and as we've seen kind of oil prices go sideways, as we've seen the cost of capital go higher, we've seen a reduction in, say, U.S. investment and U.S. shale coming online. And so I think the long-term view there is to watch what's happening with energy, watch what's happening with copper, some of these things, because that kind of gives you some signals on when the next inflation spike might happen, or it
Right.
gives you signals on how deep this current disinflationary period can get. So that's probably the number two thing I'm watching. Um, Three would be any notable geopolitical changes relating to currency agreements, to war escalations or de-escalations. Obviously, these are all kind of factors that are hard to predict. Probably tying into that point, or at least tying for the third spot, I am watching the gold price. We recently had it, it's kind of testing its prior highs. It's not really a firm breakout yet, but it's kind of been flirting with that kind of breakout zone. I'm also watching that equities as priced in gold. If you look at, say, the S&P 500, divided by gold, for example, it's been kind of this like arcing rollover. And I'm looking for to see if that does continue to the downside, or if it does something surprising. If it reverses trend, gold takes a break, and S&P 500 keeps going higher. I am kind of watching that dynamic, because one of the more inflationary thesis would be essentially that the Fed gets kind of done their tightening cycle, the U.S. enters some degree of recession, the rest of the world in some ways benefits from that, and is able to have like another growth cycle, and you see things like gold and energy and copper break out compared to things like the Nasdaq, compared to the S&P 500, that are running into more profitability problems or valuation challenges. And so that's probably a third variable I'm watching. So for me, say the 5 to 10 year view is a lot clearer than any given 6 month view. So
All
I'm
right.
watching certain factors to kind of navigate that intermediate term.
And to be clear, with that gold and S&P 500 ratio, are you watching that closely because it usually over time mean reverts?
It's not so much that a mean reverts; it's that it kind of shows you what I think what the underlying forces are. So generally, in more disinflationary decades, commodity prices are cheap. Stocks are doing very well because they don't have a lot of labor costs, they don't have a lot of material costs.
Okay.
They're doing great in terms of valuation, they're doing great in terms of corporate earnings. So whether it's the 90s or the 2010s, for example, you have a big rise in equities compared to gold, compared to commodities. Whereas when you look at the 2000s decade, which is a more inflationary decade, a more value decade, a more emerging market real estate decade, gold did quite well compared to the S&P 500. And in this kind of current period, after the 2010s were so good for equities compared to gold, we're seeing early signs of a rollover. And I want to see if that follows through. And if it were, that would kind of imply that the 2020s are probably, it kind of solidifies the idea that, you know, US large cap stocks are probably not the best place to park the majority of your capital for the next decade.
Yeah, got it. Makes sense. Okay. Lynn, thanks a lot for a fantastic interview. I want to remind everyone that you are going to be speaking at the next Rebel Capitalist Live. That's going to be May 12th to the 14th in Orlando, Florida. We can't wait for that event. Actually, it's going to be the first time that you're going to be meeting your business partner, Chris McIntosh, as well with Rebel Capitalist Pro. I'm super excited for that.
Yeah, it's gonna be a lot of fun. And I know that the prior event that you held, that I went to, I know you held a bunch of them, but I went to that
Yeah.
one, and it was definitely a good event. So I look forward to this one as well.
Yeah, I think you were at the one in Houston with Ron Paul, correct?
Yes, that's correct.
Yeah, so we got Mike Maloney this time. We got Peter Schiff. We might even have a debate between you and Peter Schiff and Peter Schiff and someone else. So you guys got to get your tickets. Rebel Capitalist Live ASAP. It's just rebelcapitalistlive.com. And then Lynn, can you tell everyone where they can find out more about your work and your website and your blog and everything that you do?
Sure, I'm at linalden.com, and I publish research there, including public articles, and I'm also active on Twitter at linaldencontact.
All right. Well, thanks again, Lynn. It's always awesome to talk to you, and I can't wait to see you in May.
Yep, thanks for having me.